Hello, I'm Mike Richter, and today we're going to talk about your three most important financial statements. And I'll give you a hint, it has nothing to do with your credit score or your credit report. Though, if you keep track of these three financial statements, you're more likely to have a much better credit score. Let's take a look at our overview. We'll talk about this thing called a budget, which you use to track your expenses and you decide how you're going to spend money throughout a month. Then we'll talk about the cash flow statement, which takes into account what you actually made in income and what you actually spent. So it's a little bit different than your budget because your budget's your plan, whereas your cash flow statement tells you after the fact how you did. And the third statement we'll be talking about is your net worth statement, where you take your assets and you subtract your liabilities. We'll get into defining what an asset and what a liability is when we talk about the net worth statement. And finally, we'll talk about how does it all come together. After that, I'll go away from the slideshow and I'll pull up a couple of spreadsheets that I'll be giving to you in the comment section down below via a Google Docs share link. So let's get started. So a budget is basically your battle plan for a given month. This is where you tell your money where to go. And if you're not telling your money where to go, usually your money finds a way of wandering away from your wallet or away from your bank account. And this is kind of important because if you're not tracking your expenses and you're not careful with how you spend your money, it's very easy for you to spend your money on things like going out to eat or spending money on your hobbies or impulse buys at your local general store like Walmart or something like that. So if you're not careful with your money, it tends to wander off. And that's why a budget is very important, so that you can lay out your priorities, and as long as you're tracking your priorities and following through with it, you're going to be much better off in the long run. Now let's talk about a cash flow statement. Now once again, a cash flow statement compares your actual spending against your actual income. So this isn't a matter of planning as much as it's a matter of seeing the results at the end of the month. So you budget at the beginning of a month or the beginning of whatever budget period you have. The beginning of a month just seems to be a pretty easy way to track it, but if it works better for you to look at it from the 15th of a month or whatever day out of the month, you do you. This is all about personal finance, and personal finance, the beauty of it is that it is personal in nature. So whatever works best for you to achieve the results you're looking for, by all means, do what suits you best. So once again, this cash flow statement is about comparing your actual spending against your actual income at the end of a budget period. It tells you if the money is flowing away from you or towards you. Ideally, your cash flow statement is going to reflect positive cash flow, which means you're retaining money over time. And that's a good indicator for you. And that is kind of like when you go to the doctor's office and your blood pressure is normal. Positive cash flow is what I would consider normal blood pressure. Whereas if you're starting to get high blood pressure, then that's where you have either neutral or negative cash flow. And finally, we've got the net worth statement. So the net worth statement is the best indicator of your overall financial health if you're using it correctly. And how you use it correctly is by correctly defining what an asset and what a liability is. The way I define an asset is something that makes you money over time, whether it's month over month or whether it appreciates in value or is a significant store of value over time. Those are the kinds of things I would consider assets. So a rental property or a website that's making you money or a stock or a mutual fund that pays dividends, I would consider an asset. Now for the store of value side of it, your own personal residence could be considered a store of value. So that's why I typically consider it an asset for the purposes of net worth. But it also costs you money over time, so you can look at it as an asset or a liability. I tend to look at the mortgage associated with the house as the primary liability associated with my house. Other examples of assets might be money in your checking account, your retirement savings. If you've got precious metals, gold and silver, I would count only the liquidation value of those things as assets. So for example, for my gold and silver holdings, I only count about 90% of current value as an asset. And the reason why is I'm fairly confident that I can sell my gold and silver holdings at 90% of current market rate at just about any time of the year without much effort or much struggle. Now, other people might have other collectibles like baseball cards or trading cards or things like that. And I would be really conservative as far as how you count that as an asset. Like, for example, if you've got a Babe Ruth rookie card that's signed by Babe Ruth, yes, it's valuable, but it's only valuable to somebody who's willing to pay for it, right? There's a very narrow niche market of people that are willing to pay the market price for that. Whereas a lot of vendors are willing to pay a significantly discounted price any day of the week. So I would go ahead and count the value of that specific collectible based on what you can get without effort. So if you needed to liquidate it for quick money, that's the amount I would count as your asset. Now, liabilities are anything that take money from you. And normally, things that I would count as liabilities are any kind of debt. So a mortgage, car loans, student loans, credit card debt, things like that. Now notice I don't count a car as an asset. And the reason why I don't do that is very rarely will a car make you more money than it costs you. Even when you purchase it. Unless you purchase it at a significant enough discount where you can turn it around and sell it for more, in which case then it would become an asset to you. But for the overwhelming majority of people, a car is typically a liability in that it costs you more money than it makes, but I'm not going to list it as a liability because it's a necessity for life, and I'm just going to count the actual car loan aspect as the liability. So how do those three come together? So this is an example of a combined cash flow and net worth statement. So say, for example, I've got two sources of income, and my total income is $6,000, $4,000 from one source and $2,000 from another source. And say, for example, my first source I'm going to count as a house payment of, say, $1,500 a month, and the rest of my expenses at $3,500 a month. So I have $6,000 in income and $5,000 in expenses. So that means I've got positive cash flow of $1,000. Now, if we look at the net worth side of it, say, for example, I may have a house that I live in that's worth $100,000, and my mortgage on that house is $90,000. So my house would give me $10,000 worth of net worth, the difference between what the asset and the liability is. So let's just look down at the assets. So a $100,000 house, $10,000 in checking, $25,000 in retirement savings, and $15,000 in other kinds of assets. So my total asset count would then be $150,000. Now that's not my net worth, that's just the assets that I have. Now let's take a look at corresponding liabilities for this example. So say I've got a mortgage on the house of $90,000. I've got a car loan for $15,000, a second car loan for $10,000, and credit card debt of $5,000. If I add up my liabilities, I'm looking at $120,000 in liabilities. To get my net worth, I would subtract my assets, I would subtract my liabilities, $120,000, from my assets of $150,000. So 150 minus 120 is 30. So in this example, I would have a net worth of $30,000. So now we see that it all comes together in a very important way when we take a look at the cash flow. Now that $1,000 a month of cash flow can either go on the asset side of the house, so I could take that $1,000 and put it into checking or into retirement or into other forms of assets, and that would be a way to increase my net worth $1,000 a month every month. That's pretty good. Or I can use that cash flow to take away from my liabilities. So say I could pay $1,000 against my mortgage or against my credit card debt or any of my debts. So that's how it works with positive cash flow. And that's a good thing because then your net worth is increasing over time. Now, what does it look like if you have negative cash flow? Then things tend to go backwards for you and you're getting sicker over time as far as your financial health is concerned. So if you had a negative cash flow of $1,000, what would it look like? So say that negative cash flow is financed by your checking account. So instead of having $10,000 in this example, you would have $9,000. So your net worth would be reduced by $1,000. You would only have a net worth of $29,000 in this example. Or say instead of taking it out of checking, you decided to charge that $1,000 worth of expenses onto your credit card. Well, now you have a greater credit card liability. So instead of being $5,000, now it's $6,000. And that would have the same net effect on your net worth. Whether you add to your asset column or take away from your liabilities column if you had positive cash flow, that ends up helping your net worth. In the negative cash flow side of the house, if you ended up taking $1,000 outside of your asset column or adding $1,000 to your liability column, in either case, that negative cash flow affects your net worth and reduces your net worth by the amount of your negative cash flow on any given month. So that's how it all comes together, why a budget is important and tracking your expenses so that on your cash flow statement, you have positive cash flow. That way, over time, month over month, you are increasing your net worth. And as your net worth increases, you're able to invest into other assets that will further increase your net worth. And that's where the real power happens. So just to recap, we talked about the budget, which is your battle plan for how in a given month you intend to spend money. We also talked about the cash flow statement, which is a statement that reflects your actual income and your actual spending for a given time period. So you're going to compare your budget to your cash flow statement just to make sure you're on track to see if you're doing better or worse than you had planned to in your budget. We also talked about your net worth statement and defined an asset as something that makes you money or is a significant store of value. And we defined a liability as something that takes money from you. And usually that's in the form of debt. Now, we also talked about how it all comes together, how positive cash flow affects your net worth and how negative cash flow affects your net worth. And we also calculated net worth. So those are the various things that we went over in this slideshow. Now, let's take some time and look at some spreadsheets that I've put together for your benefit. Their links are in the comment section down below. So we'll swap over. So this is an example of the quick net worth statement. I've got assets on this side and liabilities on this side. So currently I have no information placed into it. I went ahead and put in very basic calculations for you. So say I have a house worth $100,000 and no mortgage. Well, look, my net worth is $100,000. But most of us have a mortgage on our house, so let's add a $90,000 mortgage to that. So on the left side, we see that we have $100,000 in assets. We also see that we have $90,000 in liabilities, and it automatically calculates our net worth as $10,000, the difference between $100,000 and $90,000. And this works for all the columns. When you download it, you're able to manipulate the columns as you need to make sense for your situation. And by default, it's automatically adding up everything between here and here, and adding up everything between here and here. It's giving you the total of this column here, the total of this column here, and all the net worth is it takes this total and subtracts this total from it to give you the net worth. So let's fill it out a little bit just to play with it. So say I've got $10,000 in checking, I've got just $1,000 in savings, I've got $25,000 in retirement, I've got $2,000 in stocks and bonds, and maybe I've got a couple of baseball cards that are really worth $2,000, but I'm confident that I could liquidate it at $1,000 if I desperately needed the money. So now we total this up and we see that we have an asset column of $139,000, but unfortunately we have some debt. So say we have a $10,000 car loan, and then we've got another car loan, and we've got student loan debt still because we went to college and it cost us a lot of money. We got some credit card debt on 2 different credit cards, and as you can see, it totaled up our liabilities and gave us our net worth based on our assets and our liabilities. So once again, I've got this linked in the comment section down below, or rather in the description of the video. Now let's take a look at a quick budget. So this is also down in the information section on the video, and basically this is a way to create your budget, and it'll tally up your cash flow as well. So let's say we make $4,000 a month in our regular income, and say we've got some stocks that pay $200 a month in dividends, roughly. Now let's take a look at our giving. Let's say we give 10%, and we make sure to pay ourselves first $500. Now say we have a mortgage, everything included, of about $1,000. We have no second mortgage. Maybe we keep $100 a month for repairs and maintenance, pay $100 in electricity, $50 in water. We have an all-electric house, so no gas. We pay for cell phones, $60 a month. Trash service is included in water, maybe. Our internet, say we pay $50 a month. Car payments, say we've got a car payment of $150 and a payment of $125. Gas, we pay $100 a month in gas. Repairs and tires, we'll say we save $50 a month. Car insurance, say costs $80 a month. Personal disability insurance, we're kind of risk takers, so maybe we don't have our disability insurance. Maybe our health insurance is about $200 a month. Life insurance at about $35 a month. Child care, we don't have children yet, or we have one stay-at-home parent. Entertainment, maybe $200 a month. Food, maybe we spend $600 a month on that. Clothing, we set aside maybe $50 a month on that. And then other miscellaneous, say we spend $300 a month on our various hobbies and things like that. So if we take a look at all of the expenses we put in, considering both giving and savings as expenses, now keep in mind the saving is intentional money that you are paying yourself first on, which is really good for you because you're counting that as part of your budget, which means it will happen as long as you're willing to follow through on it. So this $500 of savings will be added to your asset column at the end of the month. Now taking a look down here at the cash flow section, we put in our income as $4,200 and our expenses, including that amount we added for savings, is $4,170. So if we actually followed through on this plan, we would have $30 additional in cash flow that would still be in our checking account at the end of the month, which is very useful for us to know, because not only are we saving that $500, but we're saving that $30 as well. Once again, both of these spreadsheets are available for you down in the information section down below. And if you like the content of this video, please give it a thumbs up. If you'd like to see more content, by all means, subscribe for more. And if you have any questions, please put them in the comments section down below, and I'll answer them as soon as I can. Thank you so much for your time. I hope you have a fantastic day.